Ladies and gentlemen, Jerome Powell, the Federal Reserve Chairman, yesterday made a surprise announcement. And guess what? The whole stock market rallied to an all-time high. And there's a lot of implication from his announcement to stock prices, bond prices, housing, interest rate, exchange rate. So please watch on if you want to know all these implications. First of all, because of what he announced, the Dow Jones, S&P 500, and NASDAQ all closed together at all-time high. And this kind of three indexes closing at all-time high had never happened since November 2021. So for me, I'm only invested in NASDAQ and S&P 500, but that's already very good news to many of us and to myself as well. Let's see what actually he said and the implications of what he said to understand why the whole stock market rallied. And more importantly, it's not just to the stock market, but its implication to everything you touched. In February and March, there were a series of bad inflation news. And I was dead sure that yesterday night when Jerome Powell come out and deliver his speech, it will be a bad hawkish tone, basically implying that he will be holding an interest rate higher for longer. That's because the CPI has been sticky for the last 2 months, around 3.2%. Nobody actually expect him to come out with what he said. And guess what? First of all, he kept the interest rate unchanged, and that was expected. Nobody expect him to lower an interest rate in the light of what has happened in January and Feb inflation results. Of course, very few of us also expected interest rate to go up, although there were some little noises in the analyst market that says that maybe he will increase interest rates, right? But you guess what? No, he actually held the interest rate unchanged, and that's a good news. To the whole stock market surprise, he still gave the green light to 3 interest rate cuts for 2024. And what is more important, that he maintained a very dovish tone for the whole inflation path. I will quote him. The story is essentially the same of inflation coming down gradually to 2% on a sometimes bumpy path. So this is exactly what he saw in the inflation path going down. And I've said many times, this is quite similar to the 1980s inflation path coming down. There was experience when Paul Volcker, the Federal Reserve Chairman, then spiked the interest rate. So this is an expected path. And he said that we are not going to overreact to 2 months of data, nor are we going to ignore it. So he said that he recognized that there are 2 bumps, but he saw that, there's already 7 months or so of inflation coming down. 2 months of data is not going to cause them to overreact. He still thinks that there will be 3 rate cuts that are coming. And as a result, the whole stock market reacted strongly. The S&P 500 broke all-time high again. And so did the NASDAQ, and so did the Dow Jones. So the S&P 500 crossed 5,200 points strongly. And guess what? My prediction in the start of 2024 January, I predicted that the S&P 500 will cross 5,200 points by the end of 2024. I was right and I was wrong. I was right that it will cross 5,200 points. That has already been done. I was wrong because I expected it to cross only at the tail end of 2024. I was so wrong. So right now, it's already crossed and we are only in March. Looks like right now, many of the analysts, including myself, are readjusting our prediction. And let's take a look at what some of these predictions will be, but I'll give you my prediction at the end of the talk. The NASDAQ 100, although it broke an all-time high, is somewhat tapering off. The NASDAQ, which is the index that is largely made up of all tech stock, has a phenomenal uplift and somewhat tapering off even with this good news. So that's largely due to Tesla and NASDAQ, the Magnificent Seven. Out of the Magnificent Seven, 2 are not so magnificent anymore. And that kind of taper off the rise, but it still doesn't change the story that the whole NASDAQ is still rising up on the increasingly positive belief that the interest rate cuts will soon materialize towards the middle and the end of the year. So this is all good news for the stock market, and we are seeing pressure of it going higher and higher and higher. What's the key takeaway from the Jerome Powell speech yesterday? Let me summarize it for you in a few points. The first thing is that he said that it is too soon to know whether the inflation has stopped. A lot of people actually had the belief that, although the inflation has come down, it's kind of stopped, not going down anymore, and stuck and anchored at 3%. Jerome Powell said that we continue to make good progress in bringing inflation down, although there's evident that there's some persistent price pressure in housing and other service sector. He actually said that we have 9 months of inflation trend coming down, and we now have 2 months of bumpy inflation. So his point is that the trend is still downwards with 2 bumps in the bottom. That's not going to change the overall story. But the question right now is, are there going to be more bumps? We can't be sure of that, and that's why we are approaching this question carefully. So he's saying that it's not that the inflation is now stopped, okay, still not coming down and stuck at 3%. He's very adamant that they must bring it down to 2%. But he says that, neither are they sure that it is not stopped. So, he required more data to see what's going to happen. The Federal Reserve is now in a wait and see mode. So, Chairman Powell has laid out the risk of cutting too soon versus cutting out too late. So, he say again that if we cut the interest rate too soon, then inflation is likely going to get stopped at a high rate. Then they will have a possibility of reinflation. Then they have to increase interest rate again. That will be too painful. But if they cut the interest rate too late, then there'll be damage to the economy because it is contractionary in nature to have high interest rates. They are on this Goldilocks kind of thing, right? Not too hot, not too cold. They're trying to be exactly at the right point. And that is a real art. But right now, they are in a wait and see mode to make sure that they get it right, and there isn't an urgency to cut interest rate. So I quote him, is consequential. The Federal Reserve believes that the economy is still very strong and the labor market is strong and inflation has come way down. So there is no need for them to overreact. When policymakers sees that the economy is weakening, then there will be a rush to cut interest rate, but not America. Economic growth in the first quarter is expected to register a healthy 2.1%, according to the Atlanta Federal Reserve latest projection. That's following 2 straight quarters of a strong 3% growth. The job market is still strong, and the unemployment rate is low. So everything signals that despite a high interest rate, there is no risk of keeping the interest rate high to bring inflation down because the economy is still so strong. Even Singapore economy, China economy, Japan economy, Germany economy, Europe economy, all the economies are weakened. Most of them are at near recession or at best 1% growth or so. And the Chinese economy, although it's stronger, is now facing a hell of pressure. What is the implication of all this? This next chart will show you what's the path for the interest rate forward, and all of us will then see the implications. So this is what we call the FOMC Summary of Economic Projection, often known as SEP, dot plot, okay, dot plot. So this is, they got the Federal Reserve Open Market Committee members to do a prediction of what they think the interest rate will be. So each of them will then do a plot. They actually summarize all the plot together, and this give a data points of all the FOMC participants' projection. So as you can see, the general trend is coming down, right? The consensus or the median is hovering around 4.5%, implying that there'll be 3 interest rate cuts for this year, for 2024, each of them 0.25% to reach somewhere around 4.5% or so. So from where we are today, 3 rate cuts is still in the bag. That's a good news, right? That's a good news. And as a result of this, the whole stock market already rallied, breaking all-time high. And what's the implication of all this? First of all, with a decreasing interest rate, generally the stock market will have an uplift. It's fair to say that taking away bubbles, taking away price earning ratio, taking away profitability, and taking away all the other noises, just based on interest rate pressure, the stock market will have an upward uplift or so. So this is the first good news. The second interesting news is that because the interest rate is coming down, bond prices in the long run should have an uplift as well. So bond prices, especially treasury bonds, will likely see an uplift because, frankly speaking, bonds are mainly driven only by interest rates. The implication is also to the rest of the world, including Singapore and Malaysia, that housing loans, okay, interest rate should be coming down as well. Right now, we're all experiencing how high mortgage rates and things like that. but the general trend is coming down. So for those people who are thinking of repricing their home loans and things like that, do take note of this trend and decide accordingly. Many of us Singaporeans who are, hungry for high T-bills or so have to be a bearer of bad news. Treasury bills from Singapore government interest rate is also likely to come down as the US interest rate comes down. They're all linked together. So if you want to enjoy high interest rates, now's the time to enjoy it. It won't last if this dot plot were to materialize. A lot of us who love shopping in Malaysia, Japan, and many other countries where the Singapore dollar is maintaining a strong exchange rate against these countries. I've got also some bad news, especially for ringgit and yen. Why is it so? In Malaysia and in Japan, they are holding their interest rate artificially low. As a result, the ringgit has weakened tremendously against the Singapore dollar, and so did the yen. And that's why many of us are to Japan right now having holidays, and some of us are even thinking of relocating to Japan. Including myself, also thinking of relocating to JB when one day I've decided to retire in 1 or 2 decades time. I've got a not so good news for all of us who are having that thought. It's unlikely that the ringgit will continue to depreciate at that rate that we are seeing for the last 1 year. Most likely there'll be an uplift in the exchange rate for ringgit, or at least depreciate much slower. I would say the same for the yen. The yen has an increased interest rate from negative to 0. And moving forward, if the US were to lower the interest rates, the yen will get stronger as well. All these are implications from the dot plot that I'm showing. And I've came to the conclusion that the most powerful person on earth is not the US president nor any other president in the world. It's a very humble old gentleman called Jerome Powell that's sitting in Washington, because his decision on one indicator will affect the rest of the world, including you and me as well. My prediction for the S&P 500 for 2024, and I've said it before and I'll say it again, will most likely land at a 5,400 points. And my view is in line with many analysts' view. So with this announcement by Jerome Powell, I'm now cautiously optimistic of what I think the S&P 500 will hit by the end of the year. I've already adjusted my prediction about a month plus ago to 5,400. It's getting more and more real. I think this year would likely end around the neighborhood of 5,400, which means it could be plus minus 100 points or so, with a lot of volatility in between. Could there be a chance that you overshoot? Yes, of course, right? Could there be a chance that crash? Yes, of course. But given barring surprise shock or positive surprises, we think that 5,400 points is where I would think it will land, and many analysts also share my prediction as well. Will there be volatility in between? Yeah, very likely, because of inflation upswings and downswings, certain geopolitical tensions that will rise, certain oil price spike and oil price dip. So many things can cause this volatility, but I would say that I'll maintain a very cautious optimism of 5,400 points for S&P 500. I would also think that there could be some retracement along the way, although it seems that this retracement seems very elusive. It doesn't change my story, because even there will be a retracement, I will be very unlikely to go in strong in this retracement. More or less allocated enough for it. This has caused the S&P 500 portfolios of mine to already gain from strength to strength. So I'll just ride the path upwards, and there is always this chance that there is a strong growing of the NASDAQ to a 1990s type bubble. And now we'll decide what we want to do when that day comes. We're not there yet, but there's a chance you'll be there. So congratulations to many of you who have made a lot of money in S&P 500 and NASDAQ. I'll just be cautiously optimistic. Don't be too happy, because once there's too happy, there's a chance for you to overreact when the market have a retracement or crash. But don't be too scared as well that the market will go down. I think the path forward is still a strong, optimistic glow for all of us. So let's just sit back and watch, shall we? So with this, thank you for watching. Always remember to give a like and subscribe to our channel, and I'll see you in a day or two. Bye-bye.